Hello, welcome to the mathematics class of this course. So I know mathematics has been a nightmare for a lot of people from their early childhood. So I'm not going to confuse you in formulas, especially formulas which you have to remember. But yes, few things you have to remember, and they are the formula on the Excel sheet which you need to know. And this class or this mathematics class will be not only helpful in only specific stock market, but it will also help you in calculating returns or assessing different kind of investments which are present in the market. So instead of telling you what exactly you will be learning, what I want to do in this class is just showcase you few things which are the scenario you would have encountered in your day-to-day life when you are comparing or assessing investment returns, be it mutual fund return, be it return related with LIC products or any other kind of return, even related with FD returns, right? So for this I have prepared one small Excel sheet which I'll also attach with this class, which you can download and see that how I have deployed the formula. Okay, so let's jump to the Excel sheet. So do you remember that you had a situation where someone told you that you can invest 1 lakh rupee for let's say 35 years, and then they have promised you certain kind of return. Let's say you invested 1 lakh rupee and they said that this 1 lakh rupee will become 10 lakh rupee, and you got a scenario like this, right? And they said that this is a very good investment product and that's why you should take it. Now you are confused what exactly you have to do. Well, this is a pure compound interest formula which you would have read in your childhood also, but in this case what we are going to do is run the compound interest formula on an Excel sheet and try to understand. This is also called the very basic future value formula. So what you need to do is FV, this is the function which you have to see. So you have taken future value. Now I have thought about one situation where someone came to me and said, invest right now 1 lakh rupee and your time of retirement after 35 years, we will give you 10 lakh rupee, and all I have to do is assess this scenario. So what I'll calculate, let's say average banks are giving me 8% return, 7.5% precisely I have taken. Some banks are giving 6.5%, some banks are giving 9% also, the early banks. So let's say I have taken a 7.5% kind of return which I can get. So with use of this formula FV, you can calculate the return after 35 years on your 1 lakh rupee investment. What I tried to do, that I simply thought, let me first put this money in FD and see how much money it becomes. So the formula is FV. Then every time you write in Excel the formula, it will give you the hint, that use this hint and exactly write your numbers. So what it has given me? Rate. So what you need to put is, you can put the rate cell. So rate is at 7.5%. It has done it 8%, rounded it off, so it became 8%. Then comma, this NPER is number of years. If you're going to calculate per month wise, you have to multiply 35 into 12 and that will become your NPR number. In this case, every year it will get compounded at 7.5%. So all I'll take is this number. Then it is showing you that you have to enter PTM, PMT. PMT is called payment. So payment is something which you do on a regular interval. In this case, we are not making any payment. It is just one time payment, which is 1 lakh rupee. And this is the present value. So present value of my fund is 1 lakh rupee. I'm going to give 1 lakh rupee. So it has to be a negative value. Another hint which you can also withdraw here is, everything which is in bracket, you have to give a negative number for this. So I have given minus and the present value of the fund, and then I'll enter and I'll see that how much money it becomes. Well, it becomes 12,56,000 rupees. So I can say that if I go to FD even, which has almost no risk, these days the bank minimum guarantee the government is giving in on FD is 5 lakh rupee. It has increased in the new budget. It is not a 1 lakh rupee anymore. So I can put my money into two banks, and even if they give me 7.5% return, my money will become 12.56 lakh rupee. What I'll get? I'll get risk-free return. I mean, if you trust your government, they will give you 5 lakh rupee. Even if the bank get bankrupted, so you have to put your money in two banks. So how I'll decide it? 12.56 I'm getting risk-free return. I'm getting liquidity because I can break the FD anytime. And then without any risk, with liquidity, if I'm getting 12.56 rupees, lakh rupee, why would I go and take the offer of 10 lakh rupee? Well, I'll not take the offer of 10 lakh rupee. So we will turn down this investment offer from any agent who has visited you and explaining you a thing like this. However, something which go against this is maybe in next 35 years the rate of return would be not the same. India will become a developed nation and the return will maybe come down to 4%, 5%. The way in US right now it is 2%, 1.5%. So that is one risk which is there, that I cannot do a FD of 35 years. So I may not have an opportunity, but then that's completely up to you how you assess. But at least if you know the future value formula, you can see whether with the current interest rate of even 7.5%, are they offering you the right return or not. I can bring down this number to 5 years, 10 years, at least 10-year kind of FD is there. So what you can do, that you can do your exercise only on 10 years and see what kind of offers other people are giving to you, and even if you go to FD, whether you will be able to do it or not. Idea was just to explain you the formula of future value with the situation which you understand now. Well, there is another situation which I have taken here, and this time the situation could be someone will tell you that keep giving me 1 lakh rupee annually and I'll give you 1 crore money after 35 years. I'm sure many of you people would have seen that this kind of offers are there. So what you calculate in your head, that if I'm giving 35 lakh rupee, because 1 lakh every year becomes 35 lakh rupee, and someone is giving me 1 crore, it is a good idea to go and grab this offer, right? Well, let's calculate how much we get if we have a situation like this, right? So let's say we have a situation like this and we have to calculate the future value of this kind of situation where you are going to get 1 lakh, where you are going to give 1 lakh rupee every year, and they have promised you that you will get 1 crore as a outcome. So again, we can go and take help of future value formula, and again the rate it is asking me, so I have given the rate. Then it is asking me the number of years, number of period, NPR, number of period is 35. Then every year payment is there. So see, the payment is of 1 lakh every year, right? And then the present value is 0, because what we are going to give is every time we are going to give 1 lakh rupee every year, right? So since we are going to give the future value, we will calculate is 8%, and then the payment of the number of year is this, and every year you are going to give money, so you'll give a negative sign here, and then you will calculate that the future value of that investment is actually 1 crore 54 lakh 0.5 crore. Well, again you see that this offer was not very great offer and you may turn this down. Even if we take 6% return, it becomes 1.1 crore, right? So this is called annuity. You can see here that in a situation like this, you get more money even if you put into FD. And this kind of calculation you can do very easily now if you know the formula of FV, and what you also know is the syntax of FV. Now, we will have a similar situation, but this time not annually 1 lakh rupee, but 5,000 rupees per month I have to give, and then for 35 years, and they are promising me here that they will give me 1 crore rupee. Now how you will calculate is, you will see, okay, 5,000 rupees per month into 12 in a year into 35 is something you are going to give, which means they will show you that you are going to actually give 21 lakh rupee, but you will get 1 crore in hand. Or let's say this formula is where they are saying, give me 6,000 rupees per month and you still give me 25 lakh rupee, but I'll give you 1 crore. Many LIC policies are like this. You can calculate the future value of this as well. So the syntax of the future value is this. Now the rate. The rate is 7.5% annually, but then we are going to compound it monthly since we are going to deposit money on a monthly basis. So rate has to be taken divided by 12. Per month rate would be annual rate divided by 12. Number of period now will become not 35 but 35 into 12, right? And then the payment every month you are going to give is 6,000. No initial amount, so no present value is equal to 0. Now you see what is this number coming. Well, this number is also coming 1.21 crore. Well, there's a reason why I'm taking 7.5% return everywhere, because every time you are going to assess any investment where there is a risk involved, point number 1, where there is liquidity involved, so risk is always there. Only in FD you don't have risk. If the banks are covered and your FD is less than 5 lakh rupee, then you have no risk of the money. While you are going into the mutual fund, it has a risk. There are products which may have liquidity issue. They will say that, okay, since it is 35 year, you have to put the money for 35 year or initial 10 year. In FD, you can break the FD anytime. Maybe some penalty will be there. But the point here is, I'm taking a FD rate only to exhibit you this, that if you go and find out the future value of a lump sum income or future value of a monthly income, then you will be able to compare with the alternative investment with FD. So now you know two formula, future value and future value of an annuity. Both of them have the same formula. In annuity you have a regular interval of time on which you are also giving the PMT. So altogether what I did was, in FV syntax we have used in one place payment, in another place we have not used the payment. In some cases you may have a situation where you will say that, okay, initially you give 1 lakh rupee and then this kind of situation, that initially you deposit 1 lakh rupee and then every month you give 6,000 rupee and then we will give you 1 crore, so you can calculate very easily now FV and then rate divided by 12, PMT, NPER, number of period. So I'm doing it in front of you because I want you to gain that confidence and I want you to do while I'm doing this and learn how exactly I'm proceeding here. So C7 into 12 is the number of period, and then you have PMT, which is monthly payment or the payment you are doing, and then you have, so see, I also keep doing this mistake, which means you will also do this mistake, so you have to remember Every time you have giving money, you have to give negative sign. So minus B7, and then present value is again something which you are giving them. So minus this, and then this number is much bigger, 1.35, which is like the extra 14 lakh rupee is something which get added because of the initial investment of 1 lakh rupee, which is also given. So now you can use this Excel sheet and FV formula to assess different kind of investments. Well, you know the formula for calculating future value. Do you also have situation where you may have to calculate the present value of the investment? So you go to the present value, and then what you see is you have been asked that you invest 10 lakh rupees right now, and your expected money is 1 crore. Number of years which you have to invest it is 35 years, and rate of return is 7%. Let's say you have to calculate the present value of this expected money. Well, for that you have a formula, just a very similar formula like future value, where you go and take the rate, NPR is 35, payment, since you are not going to get any interval of payment, 0, and the future value is 1 crore. And then you do it, you get the present value of this fund. So you can do a reverse calculation also. So if someone is asking you 10 lakh rupees right now, you can tell him that it is not 10 lakh, but 9.36 lakh rupee at a rate of even 7% will become 1 crore. So vice versa, you can also calculate the present value using the formula of PV, which is very similar to the future value. However, in most of the case, you will need to calculate the future value, but in some cases, you have to calculate even the present value to compare it. Now, you learnt about one-time payment, then multiple interval payment, which we called annuity in future value. Similarly, you can calculate the annuity of the present value. So here you have a situation that someone asks you 10 lakh rupees, and then they tell you that, okay, if you give me 10 lakh rupees right now, I'll keep on giving you 1 lakh rupee every year for next 15 years. Now what do you think? Right, I'm giving 10 lakh, but it looks like I'll get 15 lakh rupees in return. So can we calculate the present value for this also? Well, we can calculate the present value using the similar formula PV. The rate of return on this side, we will again calculate as 7%. NPR is, number of year is 15. Payment every year we are getting is 1 lakh. So we can write here 1 lakh. And then what we can see that at the end of the year, we are not getting anything. Correct? Since every year they are going to give you 1 lakh rupee. In this case, at the end of the year, they are not going to give anything. So in the final FV, you will have to put 0. If you see this situation, you will come to know that you just have to invest 9 lakh rupee to get 1 year 1 lakh for next 15 years, right? Why it is coming in red? Because I did the same mistake again, and the mistake is I have to put negative sign in front of 1 lakh rupee, and then you can see that the annuity of the present value can also be calculated using the similar formula. So formula of present value and future value is something which is clear to you now. Apart from these two formula, in their annuity format, we have a different situation. In this situation, you have to assess two things. Now you have to assess one company where you want to invest, So let's say you are assessing one company, and this company is going to invest 1 crore in one project. And they are saying that by investing 1 crore, 20 lakh rupees every year they will get as a profit for next 10 years. And then after 10 years, the machinery which they have set up will be sold only on 20 lakh rupee because of the depreciation. But they are raising debt, business debt, you know. So business debt is, let's say, coming at 14%. And then they are proposing you this situation where they are saying that they will going to put this plant and have this kind of cash flow. Then you want to basically know whether this kind of cash flow is a right cash flow or not, whether it will give me a positive net present value or not. This is also called the net present value, right? So you have another formula to calculate this, and this is called NPV. And in NPV, it asks you rate. So here the rate is 14%. And then it just asks you the cash flow of next 10 years or the time period you are going to see. Again, check here that NPV, when you write, what it's showing, rate, value 1, value 2, so till infinite value, right? This is what I have done. Something which you have to understand here is 1 lakh rupees is the negative thing which you have invested in the very beginning. That's how you have to take. 14% is the debt at which you have taken. 20,000 every you are getting. And finally, in the last year, you are getting 40 lakh rupee. Why you are getting 40 lakh rupee? Because 20 lakh is something which you get every year, and 20 lakh is the post depreciation asset value. So you get at the end of the day 40 lakh rupee. Now, when you calculate this, you see that the present value, NPV, net present value of this project is coming positive of 8.5 lakh rupee. So someone who is considering this format to assess whether one company is going to do the right thing or not can go and assess it by doing NPV. We are going to use this in our valuation class. That's why I have brought this formula NPV in the beginning of this course itself, where we are learning about the mathematics of a stock market. There is another way to assess the similar kind of project, which is also called the IRR project, internal rate of return on this project. What exactly it could be? So I'll go and use IRR function, and then it is just asking me to give them the value. Well, I have given them the value in the similar format, because this time we are calculating rate of return. I have given no rate, but we are looking for the rate. Well, this project have an internal rate of return which is 16%. So considering a debt of 14% is still okay. Maybe not all money will be taken into debt, but if the IRR of this project is 16%, one can think about investing into this project, because they are not doing any foolish decisions. So two formula more you have understood is NPV and IRR, right? I have taken these examples to explain you that how you can assess other investment in terms of comparing it with FD, which is a real life situation. NPV and IRR I have told you because from a company perspective, because at the end of the day, you have to learn to value the project of those companies, right? In your own situation, you can also identify what is the IRR of one of your investment. So without any preparation, I'm going into one example and trying to see how in our investment, our own investment into some stock or anything else, how it can work out for me. So for that, let's take one example, and this time the example will be from stock market and our investment into stock market. So let's say we go to screener.in, and what we see that, let's say we want to go into TCS. Okay, so TCS is showing me that it is giving 1.35% dividend yield, right? Then I go and check for last 5 years the stock price is 1400 to 2200, right? Let's say I have to calculate that what kind of IRR this company could have given me on my investment on considering the stock price and also the dividend which I have got. So let's say in this case, instead of 1.35%, I'll keep it constant to 2% because this is last year dividend. Consider we got 2% dividend every year and the stock price has gone from 1400. Let's say we freeze it to 1400 and here we freeze to 2200 in 5 years. And we want to see what is the total return we could have got into this stock. So for taking this example, present value is 1400, future value is how much? 2200 rupees, and the future value here is basically the terminal value. Something probably I missed telling you is one terminology, which is terminal value. So terminal value of the project is 20 lakh rupees into this scenario, where you understood that after 10 years, the total cost of the project which will be there after depreciation is only 20 lakh rupees will be called the terminal value. In this case, our terminal value is 2200 rupees because we are not only going to get the dividend meanwhile for another 5 years. In 5th year, we are going to get the stock price as 2200 rupees, which is the terminal value. So anyone who would have invested 1400 rupees and would have got constantly 2%, 2% is 28 rupee on year 1, year 2, year 3, year 4, and in this year 2200 he would have got plus 28 rupees dividend again. So 2228 rupee is something he would have got, you know. So present value or the investment value, I can say in this case, is minus 1400, and now I have to calculate what IRR for this investment in last 5 years. So what is the return I got on TCS? 11%. So if you understand how to go and use NPR and IRR, you can have these kind of situation, real life situation, where you can understand how exactly to get the actual return in percentage or actual money you are going to get after investing into different kind of assets, compare them with different interest rate. So I would say get familiarized with NPV formula, IRR formula, present value formula, and future value formula. Also understand the concept of annuity and learn how to enter the right value in the right cell. I could have taken you into a typical mathematics formula and shown you, but then you would never remember. What you have to remember is this: as a stock market investor, that you can calculate it within a minute, the return, the total return, rate of return, return on the project, total net present value of a project, and these kind of things. So thanks for attending this mathematics class of your stock market. We will move to the next class, which is on business strategies, which will be a stepping stone before going into our fundamental study class. So fundamental module will start after the next class, which will be on Porter's 5 forces and also about SWOT analysis of the company. These are related with the businesses. Investment is all about stock market investment is all about investing into different businesses. So what are the famous models of businesses which assess the strength, weakness, and competency of one business is something which we will learn in these two topics, Porter's 5 forces and the next topic, which is SWOT analysis. We will take one or two companies or industry example and try to understand that. Well, With this note, thank you. Try to take different examples from the market where you see different kind of offering which has been given to you, from different advisors, different companies to invest for longer period or shorter period kind of thing. You can also use this formula to understand that at even a very decent rate, if you keep investing into stock market, how much money you will make, included with dividend, is something you can calculate. Value investing is based on the power of compounding. This formula are nothing but power of compounding formula only, right? So thank you very much for attending this class.